makes your business better, different to somebody else's? And can you calculate profitability? Because I think we all think our businesses can be profitable, and sometimes we think we're just selling, but can you actually calculate the profitability of your business? As I bring this conversation to a close, Babzulu, as an accountant, I'm now going to tap into your skill. We often talk about funding instrument, funding types. We've got to speak to the right person to understand what funding you need. And I don't think enough gets spoken about the different funding instruments and the different funding types. Do you just want to give us like a quick idiot's guide to when somebody says, do you understand the financial instruments that are going to make your business work? What are you as an investor or a funder actually asking us to consider? What are the various things? And people say debt funding, blended, equity, it's long. I'm sure we'll go to a dictionary. Okay, now let's pull out our dictionary. Kane, what is debt, funding, equity? So just give us like a round trip around funding instruments. Thanks.
I see what you're doing, Dudu. You are testing my ability to simplify things that are clear.
Thank you, thank you.
I walked into that one. So I'm going to start with the two broad categories and maybe just double click on each one. So really there's two fundamental ways in which a business is funded. It's either equity or it's debt. Equity is owner's own funding, whether that comes from your savings, your other investments, whatever the case is. What that buys you is ownership and control of the business. So you'll find that most entrepreneurs do not want to give up that equity because with it, it goes with control. And there's a real risk of selling equity too soon. I'll give you an example. I was reading this article. I'm sure a lot of you are familiar with the story. Everybody knows the two famous founders of Apple, right? Two young guys who ran that business and turned it into what it was. But they actually had a third partner who was a lot older than them. And he sold the business, I think in 1976, for $800. And it was 10% ownership in Apple. Theoretically, that 10% ownership is worth about $400 billion today.
Wow.
He sold it for $800, it would be worth $400 billion. Interestingly, when he was asked if he regretted that decision, he said no. He said he sold that interest in Apple at the time because compared to Jobs and Wozniak, he had a family, he had a house, he had a car, he had something to lose at that point in time. These two young guys didn't, and because the business at the time was structured as a general partnership, it means his assets were also at risk. So he made a decision to protect what he had. So you and me sitting here today have the beauty of hindsight. And everything makes sense when you go backwards and say, but you could have made 400 billion. He would have had no way of knowing. I'm telling you this story because that's what having equity in a business, that's what considering whether to keep or sell equity or invite another partner potentially buys you or loses you. So that's the one category, which is equity. And then debt is the fun part. That's when you now invite other people to invest in your business. And debt, by its very nature, at some point you have to pay back. Those people want their money or else. So that's the risk in taking debt because it is a fixed payment date, unlike equity, which is generally permanent. But also what debt does is it doesn't give control in the classic sense. It's still your business, you own it. But there are restrictions that come with having somebody else's money. So if I have lent you money, I don't want you to go to the other bank and take on more debt because that's going to compromise your ability to pay me. So I'm not trying to control you. I'm protecting my investment in your business. But unlike equity as well, debt has fixed payment schedules. When that installment becomes due at the end of the month, at the end of the quarter, as the case might be, I don't care how well or how badly your business is doing, I need my money. So if you compare the two, equity is a lot more patient, whereas debt tends to be a lot more short-term, and the payment obligations in debt are certain. And there are negative consequences if you don't make those fixed payment schedules. But within debt itself, there are different kinds of debt. You often hear people talk about senior debt. What that simply means is that senior debt gets paid first before any other debt. So typically your bank debt will be senior debt. You'd also have something called mezzanine debt. So it's a level below senior debt. And then you'll have something called subordinated debt. Subordinated debt typically comes from shareholders, right? Because there's also a pecking order in how the capital of a business is repaid.
Okay.
So if something goes wrong, you as the equity holder gets paid right at the end. And typically that means you get nothing, because if there was value in the business, then it wouldn't have gone belly up. So that's the risk you're taking. And then it's subordinated debt that follows next. It's mezzanine debt, and then it's senior debt. So senior debt holders get paid first, but they also get typically they charge a lower interest than, say, a subordinated debt holder, because they take on slightly lesser risk.
Yeah.
It's probably secured. So your mortgage, for example, is an example of senior debt.
Okay.
If you buy an asset and the lender takes that asset as security, that's senior debt. If you have a working capital facility that is unsecured, that is going to be more expensive. So we can spend the whole day talking about that.
I'm sure.
Some of you already can tell that I'm a nerd and I enjoy talking about this topic, but hopefully that gave you some semblance of what some of the fundamental funding instruments
funding
exist
is,
out
yeah.
there. If you take anything else away from me, let it be this. Equity, it's your money, it's your control. Debt, it's somebody else's money. There is therefore a discipline in how you run and operate your business that you have to adhere to, because the other person wants their money. Thank you very much.
So on a scale of 1 to 5, for a person whose superpower is simplifying things, does he get a 3, 4? 10 out of 10. Wow, there you go. Thank you so much. So thank you so much, Alon. I will be coming, but not with a cup of tea, as I said. I'm gonna bring nothing when I come and see you. Thank you so much for those tips and those tricks and hacks to being more investor ready, Mr. Zulu Nyabonga. Finally, as senior citizens, as we work towards being a senior citizen, I'm going to be very happy to use the word senior debt. Senior. I just heard senior. Yes, I'm a senior debt finance person, so that I can know which I'm going to be the first person that gets repaid when I have lent money. So with that, I know time, zip the conversation, but time is not on our side. Thank you so much for your time. And continue to make this country work through the work that you do of funding on. Please give them a round of applause. Thank you so much, everyone. So we're going to move on to our next executive fire chat. There, great. If I may have Mr. Julian, I was trying to pronounce the surname, whether it's Mixon, but you are going to correct me, and no, Sislengiwe Makatini. We're now going to get into, often we talk about development finance, and we talk about all the instruments that government has put into place around helping us be better entrepreneurs or funding our businesses. So we now get an opportunity to sit and talk about those. If my guests could please come up on stage, Mr. Julian and Usislingiwe. I'm excited to be having this conversation with you. Julian is the acting fund principal at the PIC, and Usislingiwe is the group CIO at the IDF Capital. Please give them a round of applause. Welcome to EmpowaEntreprenuers Funding Summit. every time we have people that there's a capital at the end or investment, anywhere in the name, people are automatically saying, that's the person to go get funding from. So all our entrepreneurs are really looking to get a good sense of what it feels like when we're in your ecosystem. We want to understand where the trends are. And as entrepreneurs, we've got to constantly be thinking about where are the opportunities, constantly thinking about where is funding going. How can I pivot my business? What is the new thing or the thing that's going to make the pots do what they do in the future? How do I step into that environment now so that I can ready myself? So I'm going to kick off this conversation by asking both of you, my favorite question in the whole wide world to ask people really is, what is your superpower? Because that conversation, and I believe, from a personal agency perspective, if we understand who we are, it's also easy to function in your space and to take over your space. So I'm going to do ladies first, or shall I do gentlemen? Let me do ladies first. Sisling, I'm first going to ask, what is your superpower? And I'm going to ask you in one sentence, what is the way that you would want to be introduced? Because I've got your CV here. What would be the best way to introduce you?
Good morning.
Just put it on.
Good morning, Dudu, and good morning to all the entrepreneurs in the room. My name is Hlengiwe Makatini. I think I call myself a development financier at heart. That's what I do. I work with entrepreneurs to make dreams come true.
I like that. You work with entrepreneurs to make their dreams come true. And nobody clapped. Ha. I want my dreams to be made true too. Julian?
Good morning, Dr. Dudu, and good morning, everyone. Thanks to EmpowaEntreprenuers for the invite. It's Julian Mixon. So you were right, the first
great.
time right. I'm the acting fund principal at the early stage fund at the PIC. My superpower, I'd say, is to make a difference. I believe that wherever you go, you should make a difference. Leave the room better than when you found it.
I like that. Leave the room better than what you found it. So I like the idea of development finance, but I never know what it means. So this is an opportunity for me to ask all those. They say there's never such a thing as a silly question, so this is going to be my chance to be like, I keep hearing development finance. Sislingi, what is development finance?
So development finance is primarily government institutions, right?
Okay.
So it could be local ones or international ones, depending on the size of your business. Because in markets, generally, there could be failures. If you look at commercial financiers, they are there to make money. That's their primary reason for existence. They have shareholders, they have people who want them to give returns. And you'll find that for business to be at a point where normal commercial finances are comfortable in funding them, they need to have passed certain risk levels of their business life. So development financiers are there for the bridge from when your business is very high risk to then, build it until it can transition to a point where normal commercial financiers are comfortable with funding you. So that's primarily what development financiers do. They take the early stage of business risk of entrepreneurs and help you to transition to be a business that can go to a bank and raise other types of funding.
So you guys are kinder to entrepreneurs. You're more patient with entrepreneurs. You really take a developmental approach to entrepreneurs. So in any given setup, I'd be like, I'm going to Auntie Dudu's house, I'm going to Auntie Hlengiwe's house, and I'm going to go tell Auntie Hlengiwe about my business. And you're not going to be like Alon, who's going to be like, I'm looking at your tea. I'm looking at the thing, I see my interest is waning. So is development finance around really patient financing? Is it that place where we can go to and somebody walks us through the step? Is that in its reality? And maybe, Julian, let me ask you that in the PIC. Are you guys actively patient with entrepreneurs?
It depends. Define patience. So, as the early stage fund, yes, we are patient. Typically, our investment horizon is 7 to 10 years.
Okay.
So most of our funding goes indirectly into fund managers, and we look to back fund managers who then have a typical fund manager structure. We would be the limited partner, they the general partner, and those funds have a 10-year lifetime. So we expect, if we gave you money today, to receive a return within 10 years. According to me, that's patient.
So 10 years is patient, so nobody's coming, knocking down my door after 36 months?
No. However, we do want alignment.
Okay.
So we ensure that if you're the business owner, that when we're not sleeping, because things are not going well, you're also not sleeping.
Sure. And as IDF Capital Sislingiwe, when you guys are looking at the kinds of businesses that you're funding or the kinds of sectors that you're funding, and where is the opportunity? And I'd like Julian to also answer this question, so that as entrepreneurs are sitting in this room, they are thinking about their current business and they can say, oh, cool, my business is fundable from a development finance perspective, but they're also looking to new frontiers where they could potentially tap into that. What are you finding in your space around where the growth is, and what is currently happening from a funding perspective? Where is the money going?
Yeah, so our current fund actually that we are implementing and raising for is innovation fund, because so in business there's the normal run of the mill, businesses. So we'll always eat food. So, there will always be businesses that are around food. And it's just for you to find the right niche for yourself in that value chain so that you can, demonstrate you can make money. So we'll fund those businesses. I mean, we recently funded the vegan chef. So there's everyone nowadays is, trying to live healthy and live the world a better one than we found it. So it's food, but it has a bit of, innovation in that they are making vegan eating more attractive. And then there is the high-tech kind of opportunities, which are huge, because as we become connected or digital people, we then need to say, how do we even service better? And to service the digital world, you need infrastructure. There is huge opportunities in ICT infrastructure. One of our businesses that we recently supported is providing connectivity in the rural areas. I grew up in a rural area. When I go back home, it used to be a real struggle to get proper internet. You have to go and be at a certain peak to get connectivity. And there are entrepreneurs who've actually identified that opportunity, because the big guys, they already have huge costs, and for them to try and go and bring connectivity in a community of 1,000 people, the density is not enough. So it then requires entrepreneurs who are going to find technologies that can deliver connectivities in those areas, and it becomes very easy to provide funding. So innovation, technology infrastructure is really one of the big growth sectors.
And I've got people's eyes are like, okay, technology, infrastructure, agriculture, agri-processing, because we've all got to eat, right? If there's one thing, and every time somebody comes to your house, the first thing they ask for is daily Wi-Fi password. So now when we go to Lalin, we want to be able to enable that too, because the thing around technology especially, or access to the internet, it's now been declared a human right, right? So it's a human right, and people in rural communities also deserve to be connected. So don't say I didn't plug you, ne? Agri, tech, innovation, infrastructure, ICT infrastructure in particular is what Sislingiwe is seeing. Julian, what are the trends in your space? Where is your money going? and where would you like your money to go and not enough people are coming to ask you for that money?
That's a loaded question. I'll start with providing some context. So, the Public Investment Corporation is the largest asset manager in Africa. We currently manage close to 4 trillion, of which that amount is split across listed equities and then unlisted. So I fall within the unlisted space, specifically within the early stage fund. So everything I'm going to talk to now is contextual around the early stage fund, but there are other areas of the business that cover other things that I don't mention. We've got around 4 or 5 key areas that we focused on at the moment. The first is the township and rural economy. So you'll recall we had a RFP that went out last year, and the intention was to get funds or intermediaries to apply. And the reason for that is that we want to be inclusive, and we understand that the township and rural economy is currently underfunded and underrepresented when it comes to institutional capital. Secondly, we are focused on clean energy.
Okay.
So last year we announced a commitment of around 1 billion rands into climate fund managers, and they are also a fund manager where they're raising between 10 and 15 billion rands, of which it will go into climate mitigation technologies and green hydrogen. And the reason for that is that there's a strong global agenda now for decarbonization and the reduction in carbon emissions and to get to a net zero position. The third area, and Hlengiwe is a friend of ours, an investor in IDF. So the third area is technology and digitization. Okay. So we are heavily driven by our 2 clients, or our 2 sources of funding. We get funding from the government's employees pension fund and the Department of Science, Technology and Innovation. Because we deploy and invest capital on their behalf, we need to be responsible stewards and good stewards of the funding that we manage. And we have a mandate, which is a contractual relationship, which governs what we can and can't invest in. So as the early stage fund, we are heavily driven by innovation and technology, and how can we catalyze and grow the intellectual property that is created in South Africa. So the reason for that is we have an internal research and innovation team. Okay. And what they do is help drive strategy by doing research. And what was concluded is that the venture capital early stage tech environments in South Africa, similar to the other sector I mentioned, is underrepresented, underfunded. And so we want to see more black fund managers, we want to see more women fund managers, and we want to ensure that venture capital is not limited in the hands of a few, but is more reflective of the society in which we live. And then the fourth one, to answer your question and round up, is we launched an early stage mining fund. Okay. So the early stage mining fund is from bankable feasibility study, forward or backward, depending on which way you're looking. So it's pre-commercialization. And there, the logic is how can we catalyze and grow the amount of funding that's being invested into critical minerals. And again, if you think globally, critical minerals is a strategic resources. Yeah. In South Africa, we have an abundance of it. And I think it also talks to some of the global trends taking place around AI, data centers, e-mobility, where critical minerals are a great source. I'll stop there. Thank you.
So as the entrepreneurs in the room are sitting here and have understood what development finance is, who thinks there could be a potential applicant to either the PIC or the IDF, or IDF Capital? Okay, so I'm going to just ask one person to help me understand why they think a development institution would work for the kind of business that they're doing. Okay, only because you're wearing pink and you caught my eye. So, and I did see somebody here first. It's not Women's Month yet, so I can't even have that as an excuse that you're a woman. So please, can I have a mic here? And I want to practicalize what it means and to help us understand the difference between development financing and the typical finance instruments that we've heard about earlier. So I'm going to give you exactly 1 minute. So I'm going to sit. When I stand, you must know that your 1 minute is up. Ne?
Hello, everybody. Someone who knows me, please take a video of me, content.
There we go, content.
Okay, my name is Fenza Mokale. I'm a product designer, currently focusing on jewelry design as well as these.
Okay.
So this is a key holder that is also a digital business card.
Nice.
So I think that IDF, that's where I would be because of the technology digitalization.
Nanzo, don't worry. Don't worry.
Yes.
So I like
think
that.
I've
So
answered
you
your
have.
question.
And you're nice, brief and short, which is what I like. So we've
Thanks.
got something very practical. It's a keychain, but the innovation is on fleek because now you use that as your business card. So let's just take a moment to use this as an example, Sislingiwe, in terms of if she came to you, which bucket would she fall into as a business? And if this is something that you would consider and why. And you will wrap us up, Julian, with we're using the same business. So let's use them as a case study, just to show us practically what would happen when somebody gets into your environment with such an idea.
Yeah, no, thank you. It's a beautiful idea. So, because I'm assuming you are at early stage, and it really, depends. I think the guys earlier were talking about, the types of funding. When you are still early stage and building a market for yourself, we generally recommend equity because it gives you space to focus on the business without worrying about the monthly obligations of paying your interest and your installments and things like that. So we'd look at it, and equity, people when you say equity, they think it must be big checks. Actually, I think our smallest check of equity that we've done is about 10 million, just to buy the equipment and build the market, go out there, engage with people who can buy your product. So it's important that you have enough funding as an entrepreneur to be able to engage clients, to build a strong network, and the business must be scalable. So, because if we're taking an equity risk, we are hoping that it's going to blow up. It's going to end up selling, 1 million key holders a month, and, everyone will just be happy with the outcomes. So you need to demonstrate scalability. You need to tell us, why this works better than the QR codes that people. So you need to demonstrate that yours has an edge over the other traditional business cards that people will be using. If it's a business card, does it also maybe come with a GPS thing so that if I've missed my keys, I can, So that innovation shouldn't just be, it can be basic, but it needs to be very useful to the users so that I can say, instead of, taking my phone and say, oh, here's the QR code, you get my business card, I can actually, just make you tap on my key holder. So
Awesome.
I think it would be more suitable as an equity investment, because now if I give you a loan and then after 6 months I'm asking you to pay and you are still building a client base, it would be very stressful to you, and then it would be stressful to us as well.
That's great advice, and maybe something I should have started with. So any idea that comes out of this environment is who has rights to it? Does EmpowaWorks, entrepreneurs, the fact that it came from our stage, but we are in a developmental space. Our ideas are to empower the entrepreneur, are to grow. I think that's top level advice. Make sure that it's not just entry level innovation that you add. I like the GPS idea. I think I'm constantly losing my keys, so I think that would work. And when it pops, you're coming back on the stage to tell us how the stage that made your business pop, right? Awesome. Last word, Julian, on the same business. If they came to the PIC, what would that conversation look like? And that's how we'll wrap up this conversation. Thank you.
I think firstly, well done. It takes courage and boldness to be an entrepreneur. And I'm aware that the fundraising environment is tough. Unfortunately, we are unable to consider it. We don't invest directly, and our minimum investment is usually 50 million rand, up to 250 million. However, the reason we deploy a fund approach is because we believe through our fund managers, they can get to businesses like yourself. So we've committed to close to 10 fund managers. And if those 10 fund managers do 10 investments each, we get exposure to 100 investments, which leads to diversification and less concentration risk and quicker time to market. Whereas if a small team of 5 of us had to invest in 100 opportunities, we'd take quite a long time. So we can't, but perhaps some of our fund managers can.
And this is also a great example of if you had to come to the PIC, don't be disheartened when they say no. You're just not for them. And then, it would encourage you to go and find other people, the right people to come and have a conversation with you. Thank you so much for that great advice. Thank you so much for your time. It's been really empowering. It was practical, and I know people definitely took something away from the conversation. Thank you so, so much. Okay, so please can everybody stand? I think we've been sitting for a bit. We do have lots of tea stations around, so please feel free. We won't have a formal comfort break because time is a thing today. So do feel free to go outside, have a cup of coffee, and then come back. Whilst you're standing, please can I have Ostelele? If you could please come up. Ostelele. If you could come up, Trudy Teledi, sorry, Trudy. Please come up, and I'm going to allow you to host your session. But I need you to turn around as you are standing, turn around to the person next to you and just introduce yourself. I know you all came in, some of you were late. Just say hi. This is who you are. Host Trudy, I'm going to allow you to introduce your own guests. No? Is that fine? I'm going to get you. Why don't you grab that one? Okay, so if I may, okay, thank you. All right. Okay, if you can hear me, please clap once, clap 3 times, clap once again. Okay, so Usimpiwe did say that the people sitting at the back, abomashela sone, so they have the gift of, introducing each other and just being. So I saw the lady that I'm looking at, I've made eye contact with you, and the gentleman in front of you, he was introducing himself. If I could just get a mic, and please just tell me his name, and you tell me her name, then I know, Guti, you guys were introducing yourselves properly, right? The lady with the, she's looking at me, and the gentleman, there we go. So just tell us his name. If you learned anything else about him, that's also okay. Okay, I need everybody else to give her space.
I didn't get his name. I forgot his name, and that's all I heard. That's all he gave me.
And give the mic to him.
She said she's Tabiso, and that's the most thing that I've grabbed. And then,
so Tabiso is her name?
Yes.
Okay, can we give him a round of applause for remembering her name? So, entrepreneurs, we're here to network. We're here to connect. We're here to build an ecosystem, to build a network. We're here to get customers, everyone. So keep these 3 things: capital, customers, capital and customers, those 2 things. So speak to people, understand what they do, who they are, where they come from, so that by the end of today, you have a real connection. So I'm going to do this exercise again later, and make sure you grab people's name and the business that they're doing, and if they may be your customer. Trudy, you've got the next 20 minutes. I know time is not of, you've got the next 20 minutes with your people.
Good morning. I'm glad we took a bit of a stretch. It's very important. My name is Trudy Teledi, and I will be facilitating the next panel discussion. Our topic of discussion this morning is Venture Visions to Equity Evolution, what VCs and PE funds actually back in 2026. There are many evolving trends in the market, and we simply want to know one thing. How do we position our businesses in a way that gains us access to that capital, right? So this conversation is designed to help us bridge that gap between what founders think investors want and what investors are actually backing. So without further ado, I'd like to call on my speakers to come to the stage, please. Tabelo Rachuhule, CEO of Savant Foundry, if he is here. Tyrone Moodley, Principal at Havaic. Francisco de Silva, CEO at Sizoba Group. Sherwin Sampson, Group CEO and Investment Fund GP at Samfield Capital. Sihle Gumede, Investment Director at Sanari Capital. And Dion Mhlaba, Executive Director at Energy Venture Capital. So I see some of our panel speakers are not inside the building. So I'm just gonna, I don't know if the MCs are able to give us maybe 2 minutes to get a hold of them because they are here. We just need to get them inside. So just maybe 2 minutes if that's okay. The speakers are here.
Yeah.
So the rest of them, there's some way. Just go ahead without them.
Sorry?
Where are the other speakers?
I have no idea. I think he's collecting them, so.
So I only have Dion, Francisco, and yes, he was.
Well, you guys, so while we're just setting up, let me just take the opportunity to use this opportunity. Okay. So just to do some announcement, we've got a car that's blocking, can you just show me again? We've got a car that's blocking an entrance that we desperately need. CG74KDGP, please may you move your car. That is a BMW CG74KDGP. If you could please move your car. And just to announce that SIFTA is ready set up. The SARS team is also set up. So if you've got any issues with SARS and with SIFTA, they are ready for you as well. Are you ready?
Yes.
Awesome.
We are missing one person, but oh, there we go. All right, I'm just going to get straight to it. So when founders think of funding, they usually focus on the product, the pitch deck, or how much money the business is going to make. But investors are often looking beyond that, right? They want to understand the founder and how they think, how they solve problems, and whether the business can grow long term. So Tabelo, what are the biggest qualities you look for when assessing founders and startups for growth potential?
So it's two things, because we play at a very, very early stage, where the business at that level, it's actually the founder themselves. So that's what you want to see, whether this entrepreneur understands the problem that you're solving. Because we always saying to them, or all the founders that we work with, we need to obsess on the problem or the challenge that we're solving with the business, but not necessarily the technical capabilities or how better the product is. So those are the kind of things that we look at. Do you really understand what the problem is? Do you understand who owns the problem? So that speaks to the customer. And at that customer level, you also want to see the understanding that sometimes a user or a customer is not actually a paying customer for your product. So you want people to understand that some solutions might be, this is what the community will benefit, but in this case, my business model is off the back of a corporate or government being a paying customer for that user. So those are the kind of things that we look at. You're coachable, you understand the problem that you're solving, and we have never had a doubt that South Africans actually have technical capability to build the solution. So that's always the last conversation that we have. And when we look at founders, that's the first conversation they actually want you to get into. They want to explain how much they've been in that solution, or they've been building that solutions, and how it's better than what we're seeing out there. But our approach is quite different. We want you to obsess about the problem, understanding of how it is that you can build a sustainable business off the back of that. So sustainability is more on, do you understand how big the market is, how big the problem is, and can you quantify the problem based on, can be a loss of revenue for your customer if it's a B2B. It can be a convenience or a savings on cost. So if you understand that, then it means if I quantify my problem in that first meeting when we meet with them, then a pricing question, then it's sort of a byproduct. It's just to look if it's costing you 20,000 a month to experience this problem, and I've got a solution and I'm selling it for half the price, it becomes a no-brainer. So it's those kind of things that we look at.
Yeah. So basically, you need to understand the pain point. You need to understand the problem, and then you also need to be able to understand if there is a market for what you're trying to sell, right? And you also mentioned the fact that you need to be coachable, right? And once a business starts growing, many founders assume that scaling, because that's the buzzword, right? Scaling simply means making more money or expanding into new markets. But growth also comes with challenges around leadership, systems, operation, and managing people. So Francisco, as both an entrepreneur and ecosystem builder, what do you believe founders misunderstand most about scaling and business?
Yeah, for sure. So the first aspect I want to approach when we talk about scaling is I was having a chat with a friend of mine the other day who grew up in a township community. And he said as a kid, he always wanted to have a Gusheshe. He wanted to have a Mercedes because it's what he saw and it's what he knew as success. And I think that's the same thing most African or South African entrepreneurs face, is they only know the context of our country. So when they think about scaling, they think from the perspective of how can we grow in South Africa, not necessarily from the aspect of how can we grow across the continent, how can we grow internationally. And we can't blame them for that, because in order to change that mindset, we need to grab the entrepreneur by the hand and take them to see the opportunities that lie overseas and lie in the different markets. Because if you're creating a 3D printed prosthetic for South Africa, your target audience might be 100,000 users. But if you're creating a 3D printed prosthetic for the entire globe, your target audience is now 10 million people, 100 million people. So I think the biggest aspect founders face when it comes to scaling is their own mindset and belief as to what's achievable. And if we can show them what the possibilities lie across our borders, it changes their mindset, and they need to see it first.
So there's a great need for exposure. And at the same time, many founders spend a lot of time preparing pitch decks and presentations, but still struggle to secure funding because investors are looking at more than just the presentation itself. So Tyrone, what are the biggest mistakes founders make when pitching to VCs?
Well, I think very importantly, the landscape has changed somewhat. International interest rates have increased. There's lower liquidity in the market. There are fewer exits. That's made the people sitting on the opposite side of the table of you a little bit more circumspect about the idea of vision, the idea of hyperscale growth. What we're really looking for is some realism, a good understanding that you know the ins and outs of your unit economics of your business. Now, that doesn't mean a requirement for management accounts or IFRS accounts. I'm not looking for the accounting answer. What I'm looking at, do you understand the fundamentals about what you are selling into the market, how to leverage that, what are the margins in and around it, what does it really mean and is going to cost you to expand outside of the borders of South Africa, looking for a much larger market either regionally or internationally. If you understand those like the back of your hand, your pitch deck could be written on a piece of paper rather than a pretty PowerPoint. And that's going to convince me more than a fancy looking pitch deck.
If you do have questions, can you please just write them down so that we can engage with the investors? Part of the confusion also comes from not fully understanding the different types of investors. Many entrepreneurs use the terms venture capital and private equity interchangeably, and even though they fund different types of business at different stages. So Sherwin, we don't have Sherwin here today, right? But can I throw this to any of you to answer this question, because I think it's crucial. There is always a need for the distinction between the two, because there's a stark difference between the two. So who's willing to take this question? Okay. Sihle, I see you wanting to answer. Okay, so the question
I can
is...
take it.
So the question
what is
is
the difference, right?
Yeah.
So there are various types of investors and types of capital, and VC is one of them, private equity is one of them, but you can even look broader than that. Private credit is one of them, impact funding, more sort of developmental finance is very different, and it operates at different stages of the businesses. So if you are pre-revenue generation, you have an idea in your mind that you think is really important and it's going to be a viable product someday, or product or service, you may be looking at businesses such as Francisco's business, where they sort of help you with the incubation of your idea, the turning of your idea from an idea to an actual business, right? They can help you with that type of funding. Their role they play is really just at that stage, taking from idea to an actual business, right? And then you get people like Tyrone, who works in a VC space, and I think Dion, you also work in the space, and that area of the market obviously goes from once you've got your product at least, and you're trying to prove your product market fit. The VC space will be the place that the people that you go to, because then they take you from once you've developed the idea and you've sort of established that there is a market, proving that product and market fit is where the VC will take you. And they look at really, it's like pre-profitability, sometimes pre-revenue, but either early revenue and low revenues into the developmental space. And so, and where we play, which is private equity, is more at an established level. So you've proven your product market fit, you've generated revenues, you may or may not be profitable at that stage in time. We can have a look, but your business can show that it has a path to profitability, or it is inherently profitable. And that's where we play. And we play more sort of like a partnership role with the founders and the management team. It's really about walking that journey with you to getting from small business to bigger business, i.e. scale. And that's where the private equity investors play. I hope that is clear enough. And anyone else can
chip in. I actually have a follow-up question. Just the stock difference between a debt and equity, because you find PEs usually play within that space of debt and equity at the same time, whereas with VC, it's mostly equity, if I'm correct?
So I will definitely correct you there. Private equity, it's in the name, it is equity.
It's not debt. If you're looking for debt, you can look at private credit, or you can look at just regular senior loan funding from the banks or from institutions that provide that level of funding. So private equity will just only invest in the business, in equity in the business, and again, partner with you. Debt is a limited period of time. They get an interest rate on their capital, and it's very clear around how those payment terms happen. You generate the cash, you pay a certain interest rate on it, and you pay back the capital within a defined period of time. Where else private equity and equity investment, we don't have any predetermined returns on that. We invest the capital on the basis that your business is going to grow, and we will generate a return on the value of the business going from point A to point B.
And what's the threshold for private equity? From what's the ticket size? Like from
so it
what
ranges.
amount?
Different private equity investors play in different spaces.
Yeah.
So as long as it fits within the more sort of you've reached a point of sort of established your post product market fit again, and so different investors play at different levels. We play at a level where revenues need to be at least 50 million rands. Again, it may or may not be profitable at the time, but if you are generating revenues less than that, you have to find the right equity partner that focuses on that area of the market.
Which would mostly be VCs, right?
It can be private equity as well,
Okay.
But just a smaller ticket size that they deal with.
All right. Now, another big challenge for founders is understanding where investors are actually putting their money. And this question is actually for you, Sihle. You probably feel like you've been talking for a while. There's always excitement around trends and new industries, but entrepreneurs want to know where the real opportunities are. So what sectors are currently presenting the strongest investment opportunities?
So this may be a bit of a what do you call it, a bit of a pro and a con in the way that it's put, right? Is there's a benefit in the problems that we have in South Africa and on the continent. Now, so they're real problems, and we should fix them. But in every problem, there's an opportunity, right? And understanding what those real problems are, and then understanding the structural demands that come from those opportunities, and then so the structural demand that come from those real problems, that creates the opportunity. Where we see the most exciting opportunities are where those structural demands actually meet technology and innovation. I think marrying those two is really where it's exciting, because those structural problems exist for a reason, either because the actual fixing of those problems presents a problem because you're looking at it in a sort of archaic manner, i.e. the delivery of infrastructure, for instance, right, is like you need to put roads into the place before you can get to the other side of the town, and then you have to put a school there, and then you have to put a healthcare center, right, in all of those spaces. How can you use technology and innovation to solve those structural problems? And this range from different types of industries, but we focus on, I'll just probably just may name three sectors that we are excited about. I think one of them is the social services, so healthcare and education. We know that we have a big problem in our country and on the continent as a whole on the delivery of not just the access to education and healthcare, but the quality of education and healthcare. So businesses that are trying to solve that, how can you deliver education at a more better quality with more access and at an accessible price for people, particularly in the lower LSM? How can you make education more affordable? How can you make healthcare more accessible is where we're excited to do. And what technological advancement are you using in order to deliver that healthcare or education easier and better to the people? I think secondly, I think energy and energy access. We know, what is the statistic? I think on the continent it's like 40 to 45% of the population doesn't have access to electricity. That is a dire statistic. And again, putting the infrastructure via national grids is not an option because it's going to take too long. Governments are inefficient. So what can private capital do, and what can entrepreneurs do in terms of delivering that that missing link? all right? So in ideas such as mini grids, off-grid solutions is really where we are excited. And I think lastly, any sort of technology-enabled services and B2B services, people are more and more coming into living their lives on the internet and online. AI is the buzzword, as we know. So how do you protect yourself, or how do you provide services alongside that? Like you don't have to be an AI provider necessarily. You think about ideas such as cybersecurity. The more people are online, the more security they're required to have. So what can you solve the problem of security laxes or security weaknesses while people are online? That's where we see most of the exciting opportunities coming up.
I heard someone clapping. So you mentioned the energy sector, and I'm glad that you did, because it's getting a lot of attention right now. And as the world moves towards cleaner and more sustainable energy, new opportunities are opening up for entrepreneurs across the different industries. So Dion, what are your sentiments? What opportunities exist for entrepreneurs within the energy transition economy?
Yeah, no, thank you for that question. So I think if we're to look at what's happening in terms of we spoke about scale, we spoke about IT. So all of these things require lots of power, lots of energy. I will give you an example. Every time when I go back home in the village, I'll find that they've now bought a washing machine. So meaning everything that you see every day, it's all about automation. You know, people want to do less work. There's more robotics environment that's being built, whether it's at your household or whether it's at in the business point of view. So what that means is that there needs to be more energy that's being generated in South Africa. China wouldn't be what it is today without their way of able to generate so much electricity. And more importantly, we saw during the load shedding that, you know, most of the businesses were affected. Because if you have no electricity, it's hard for you to run your business. So unfortunately, energy is in twofold. Obviously, it's there to preserve what's already there. But if we're seeing ourselves as an economy, we want to build beyond where we are today, we need to make sure that we invest a lot more in energy. In terms of what we do, obviously, from an energy side, we plug in between the gaps where, you know, the grid is too far from where the client is. And more importantly is that we've seen that, you know, the cost of energy and electricity in South Africa has been increasing double-digit for the past 5 years, which becomes a problem in terms of affordability. So we need to make sure that when businesses are launched and businesses are operating, you know, they remain competitive. Because if you can't be competitive, it means that now your products become so expensive, and then you can't now move your products in the market. So managing the whole energy cost, it becomes a very important element for South African businesses. And what we're doing, obviously, we're helping all the businesses in South Africa in terms of how to manage that particular cost, whether you want to diversify your energy security as well. Where we're seeing the biggest gap is, so when we are all here today, we all have geysers at home. So those geysers are on, they are busy using electricity. So there's a lot of technology, call it opportunity on the technology side within the energy in terms of consumption, management, you know, grid management as well, which I think South Africa has been more focused on the actual infrastructure. But I think within that value chain, there's a lot missing. What we are seeing currently now, we just saw now the price of diesel has sort of gone up, doubled for others. So we're now actually working on more of saying, okay, what's the alternative? You know, if you look at China, you look at the US, there was a whole EV discussion in terms of using a fuel cars. Maybe we can use more electricity-powered cars. So, but now for us to move into that particular environment, we need to make sure there's network. So if you drive here, you need to make sure that you can charge somewhere around here. So it is a big opportunity. And what we have in Africa, in South Africa, in abundance is the sun. So we might as well harvest the sun, use that for houses, use it for us to call it travel with. So it's to power all our businesses. So I think we're at a point where electricity or energy becomes a very important part of the economy or any businesses that we need to sort of develop.
Thank you. Thank you to our panel of speakers. I don't know if we're going to get an opportunity to take one or two questions. I'm looking at the MC because she holds all the power right now. One question. Is there anyone with a question? No, we're safe. Oh, yes, sorry. Yeah. Oh, okay. I think we're safe. So thank you to our panel of speakers. Our time is unfortunately up. Yeah, we can give them a round of applause.
Thank you, Trudy. I think the one thing I noted in the panel, and I hope you picked it up too, but we had quite a powerhouse of a panel, guys. We've got Trudy, who's a founder of Invest Age Africa. Tabelo is the CEO of Savan Foundry. Tyrone is a principal at Haviek. Francisco is the CEO. Sihle is an investment partner and executive director. And Dion is the chief executive and founder. So we have a panel of people that have walked all our talk. We've got people that understand what the life of an entrepreneur is. We've got people that are sitting behind decisions around how we get funded, why we don't get funded. I will not forget, I think it was Tyrone who said you'd rather have a business plan on I think you said on a piece of paper than have a big elaborate, document. One of the speakers also said, okay, I'll read it out now. One of the speakers also said we must harvest the sun. Have we ever in Africa, guys, needed an excuse to harvest the sun? Here with a commodity that I'm not sure if all of us are thinking about the sun quite the same. I don't think we'll think about the sun quite the same after today. So let's harvest the sun. Let's harvest our natural resources. One of the speakers, Nasitla, I want to have coffee with you. Maybe I like women that are like quite firm and like she's clear. No, I'm going to correct you. Private equity and the other thing, I was like, yes, girl, yes, 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 please. Tell us the differences between these things. We need to know what they are. So please, I hope you all are taking notes. I was taking copious notes. And the other thing that one of the gentlemen said, I think he was the first speaker, they said you as the entrepreneur need to understand yourself first. So that was another mic drop for me, and I see a couple of nods. Because if you don't understand yourself, when I then come in front of you as somebody that wants to give you 100 million, if I ask you the first question about, okay, so who are you, and you're fumbling, tell me about your business, tell me about how you calculate profits and your funding, it might become problematic. So if you take anything away from this panel, let's harvest the sun, let's understand who we are, better on a piece of paper, and you are clear about your goals. And the last one is understanding the difference with all these financial terms. So please give them another round of applause because I think they deserve it. The next workshop, I'm very excited. Samir Juma, if you may please come up. She's going to talk to us about what does it mean to be investor ready in 2026. She comes from Deloitte. Samir, look at me, regendering you. I apologize. I apologize. Samir Chuma, you know, rookie mistakes, that is what in our field, somebody's going to be like, girl, how did you get that one wrong? So I take it, I receive it, never going to make that mistake again. So we want to know what investment readiness looks like and feels like in 2026. We hear about data, innovation, AI. I'm sure all of you are using some form of LLM. I think that's like a favorite thing. Like, what's an LLM? It's not love, la, la. No, it actually has a real term. So this is a workshop. So please take out your pens. He's going to be asking you questions. He wants you guys to engage with him. And maybe let me read out Samir's profile so that you really know that you are in great hands. Samir is in strategy growth, innovation, and digital transformation. He's an executive in this field. He is a senior executive and strategy consultant, innovation specialist with more than 15 years of experience in leading technology, commercialization, digital transformation, and growth strategy initiatives across global, not just local, global organizations and emerging ventures. Samir is also actively involved in Africa's venture capital and startup ecosystem through mentorship, angel investing, startup pipeline development, early stage venture support. He is passionate about advancing innovation, financial inclusion, and entrepreneurship across the province. So we are in for a treat. Before I go, there is another car that is unfortunately blocking our ability to move in this venue. And while I get that, thank you. JYH368 Northwest. We've got a guest from the Northwest. If you would please, it's a Corolla. JYH368 Northwest. Please, can you move your car? It is blocking an entrance. Our friends from NEF are here. Our friends from SEDFA are here. SARS is here. And that gentleman that I spoke about, and I said you must go and understand how investment ready you are, they are also here. So our clinic is open. Do take the opportunity to go in and out of the clinic. It's real, it's practical. Bring your number if you have a SARS case number. If you have applied to SEDFA and you need some feedback, also take the opportunity, as we're going to break for lunch in a little bit, to walk around the stalls. I didn't have breakfast, so I'm coming for the veggie on the go. I need my full-on what. You know, they say you have to have a daily intake of X. I'm coming for the veggie on the go. Please visit the Masizana stand. So we really do encourage you, as when we're going to break for lunch, for you to take a walk around the room. Samir, are you ready? I am. So you have 20 minutes. You need a microphone. Please, may we have a microphone for Samir? Awesome, thank you.
Hi everybody, it's great to be here. I am a business school faculty member, and I've realized over time that it's better to engage with the audience than to present to you guys. And so I wanted to run a little workshop with you today, if you don't mind. Any objections? Fantastic. Cool. Okay, how many entrepreneurs are here today? If you're an entrepreneur, pick up your hand. Fantastic. Okay, can you take out a pen and paper or pull out your phone? I have the first question, which will dictate the next 20 minutes of our time. Okay, my first question for you is, on a scale of 1 to 10, how investment ready is your business right now? Don't have to think about it, just your first instinct. What's the number that comes to mind? 1 being not so ready, 10 being, yep, I'm ready to go, give me the money. The man with a 10, please drop some cash in his lap. Okay. Now keep that paper. We will come back to that in a little moment. Now, the question here today is, what would you need to get it from 1 or 2 or 3 up to 10? And I'm going to try to help you figure that out. One of the things that entrepreneurs generally don't do well, respectfully, is apply the appropriate metrics to their business. I ran a business a couple of years ago, and we were always very happy to report to investors that our transaction volume was growing. And we grew it by about 17,000%. But what we weren't measuring was how many customers we were losing. We weren't measuring what was the transaction values. And so those are the kind of things that we need to think about from it was a digital platform. These are the kind of things as investors we need to think about. I'm not sure if you're aware, there's an interesting stat that I found. In Q1 2026, more total African startup capital was raised, but 31 fewer startups got funded. So there's more money, lots of money in the ecosystem, but fewer winners. And that becomes really relevant for us today because we want to be part of that winning circle. But it also shows that investors are becoming more discerning we're making investment decisions and picking those winners. And so they're being less generous with their decision making. So everything today is about the gap that you believe about your business and what you can prove. I talk about metrics all the time because it's really important. Every single founder that I've spoken to talks about what a great business they have, what a great idea they have, that they've got this POC with this client and they've got a letter of intent from that client. That doesn't matter. Show me the money. Show me the money consistently, and then you've got a business. So my next question today is around, and I see not too many pieces of paper coming out, so we'll do this linearly. I want us to talk about market, traction, technology, team, and defensibility. I know these sound like very techie terms when we talk about what is your moat, and I'm going to simplify it. We don't need to worry about all the fancy VC terms. We're going to talk about your market today, who's in your team, is your business defensible, and those kind of things. Is that okay? I'd like you to scale your business from 1 to 10 on each of those. And here are some leading questions. So let's start with team. Has someone on your team sold into your exact target market? Have you sold into your target market? Do you have someone on your team that understands this market and this space really well? I'll give you a really good example of why I asked that question. Someone sitting in Sandton in the Ivory Tower has never been to a spaza shop, and they are building solutions for spaza shops. I talk a lot about spaza shops and the go-go's, because that's an area that's very passionate to me. But you have people sitting in an Ivory Tower trying to tell you how to sell into a spaza shop or to the go-go, and that she should take this payment device, so that she should take this type of solution. So do you have someone in your team that knows the go-go, that has spoken to the go-go, that understands the go-go? Okay, 1 to 10. The second part is around the market. Is there a market for your product? How have you calculated that there is a market? Are you sure that there is a market, that someone will buy your product? How many of you have a great idea and you're not sure that there is a market for your product? That's a good space to be in. That's quite confident. I also talk about growth in South Africa and outside South Africa. Is your target market most acutely in South Africa, or are you able to scale your business outside South Africa? What is the next market that you're going to go to? If you were to go to Zambia, what would make it true for you to go to Zambia? I heard something about keyrings or chains earlier and digital business cards. What would allow you to go to a market like Zambia? Okay, so how big is the market, and can we move to another space from 1 to 10? Traction, the most important metric here. I don't want to know how many customers you have. I want to know how many paying customers you have, because it's easy. Like, I came to the summit and they gave me coffee and muffins, and I'm sure there might be some free samples around. But it's how many people are going to actually pay for your product? How many people are going to take out their cards or their cash and pay for your product? So it's really important to understand how many paying customers you have, how much money is in your bank account, so how you're managing your costs really well, and then recurring revenue. the analytics and data platform that I spoke about earlier, we grew the business from 10,000 Rand to $3 million. We only had 2 customers. That's not an investable business. If we had to lose those 2 customers, if we had to lose a contract for chocolate to a large retailer, we could shut down the business. And so that becomes really important. So how many customers do you have? How many customers are paying? And then let's talk about defensibility. I'll tell you a story about Jason. There's an analytics company that had 7 million Rand invested into the company, and it took them 2 years to build a data analytics platform. Cutting edge, world class. They can't get funding today because there's no defensibility. Jason took 6 weeks using Claude, and he built the exact same platform as that company, and Jason now has 2 clients. So within 6 weeks, he sat at home, his daughter was behind him, his 5-year-old, screaming, shouting. He sat up till 2 every morning, and he built a platform, cost him $100 in 6 weeks, which cost another company 2 years and 7 million Rand to build. So how easy is it to copy your product? How easy is it for someone to take over? And let's talk about partnerships as well. Partnerships are part of your IP. Partnerships become really important, especially in B2B businesses. The best partners are the ones that help you get your route to market as quickly as possible. Okay, so we've spoken about all 5 of these metrics. And now I want you to, have you scored all of them? I'm not seeing a lot of writing and playing on phones. Okay. Can I have a view of how many people have actually done the exercise? Good? Okay. Now add up your scores. And tell me who's got more than 25. So you got a score out of 50. Who's got more than 25? Do you? Amazing. We're going to come to you, so get ready for... Right, yeah. Can I get a mic to the lady, please? Good. Okay. You can take this one. Lady. Thank you for speaking to us. Can you let us know what drove that so high, what your score is, what your business is? Introduce yourself.
Good morning. My name is Susan Holmes. I'm with Shonaquip Social Enterprise. I averaged everything at about 8. We are a 30-year-long company that have defended the IT something tender with Treasury for nearly 30 years. So we are accessed by Department of Health and Department of Education for wheelchairs. We are ISO accredited, and we are world leaders, not just South African and African leaders, in the development and design of wheelchairs that are resilient for environment. We sit on international boards. We work very much in terms of what the devices do for the people, what is required from the devices to be serviceable. So yeah, we're pretty strong. I will say, so I will also point out our weakness, which is a reliance on the government tender. It forms about 65% of our revenue. So our target and our reason for being here today is so that we can expand our growth into other markets. We're hoping that a 65% reliance on local government tenders actually reduces to about 30% over the next 4 years. And our target implementation is expansion through affiliates and in other areas and other countries, expansion, export into Africa, export into the UK, into India. We're not looking at the USA for now because of the amount that they sue people. So we're playing it safe. Am I allowed to say that? But that's the reason. That's the reason. So yeah, if I have any weak points, I invite you to pick it apart.
Amazing. Thank you very much. Well done. Please. I think you touched on the point I made earlier as well about chocolate companies supplying retailers and going out of business. You have a concentration risk which you want to get out of. So your defensibility might be a bit lower. You should be 8 for everything else then based on what you said. So well done. That's really good. You know? And the other thing I've realized over time is that me sitting here or the panel sitting here, yes, everybody might be knowledgeable or have lots of experience, but it's the people that you're sitting here with that actually have more collective knowledge than anyone else. You've been in the trenches, maybe not together, but if you speak to the person next to you, there might be some magic that might be able to happen there, or might they have the same challenge as you. So with that being said, I'd like you to turn to the person next to you, talk about their score, and try to understand each other's businesses a bit better. Can we do that for a minute or two?
But this was great. This was really great. After this, I'm just like, okay, I'm clearly not, shouldn't be in business.
Okay, thank you. Quieten down. Okay. It's a cool trick I learned. You need to put your hand up if I put my hand up. Put your hand up. If I put my hand up, put your hand up. Hands up, everybody. Hands up. Yep, it usually quietens the room very quickly, so it's a neat trick I learned. I've been told that I need to get off the stage because everybody's hungry and needs to go for lunch. Okay, we've touched on a few things, but most important for me was getting you to understand that you need to understand the metrics in your business and what's important to measure and keep an eye on. So I have one piece of homework for you is could you please, when you go home tonight, please think about what metrics are important in your business and are you measuring the right things? That's the first thing. Second piece of homework is before you leave today, the person that was sitting next to you and you spoke to about your score, please get their phone number and please arrange a coffee chat with that person. We need to lean on each other. Entrepreneurship is a community of entrepreneurs. And then the third thing is, in conclusion, before you kick me off, is many of us have a product. I have lots of products. But how do you turn your product into a business? And then how do you turn your business into an investable asset? And so we start here and we start working through these 5 areas to start moving from product to business. And once you get all of these right, and you can say, I'm on an 8, like our wheelchair colleagues, then you can start saying, now I have an investable asset, I'm going to speak to a funder. It was lovely speaking to all of you. Thank you so much. Have a good day.
Thank you, Samir. And I gave him a bit of time because of that boo-boo that I made. So maybe I should make more mistakes with people's names, and that's how you get in. That's how you get extra time from me. Thank you so much. That was so practical. I love that flywheel. Product, business, investable asset. Product, business, investable asset. And if those are the only things you remember from what Samir said, please keep those in mind. How do we turn our products into businesses? That we are actually entrepreneurs that run businesses, and then how are those businesses developing or creating investable assets? Thank you so much, Samir. We really appreciated that workshop. It was nice and practical. Viwe, Dini, please can you and your panel come up on stage? We are going to be talking the DFI mandate, development capital and commercial lending. You are going to be in conversation with Mr. Barnabas and Lebaka. So if you could all come on stage and let me, while you are finding your way up on stage, you do have 20 minutes and you're thinking, I'm going to do it in 15. Look at that. Look at God. You're going to do it in 15 minutes, but you do have a full 20 minutes. Please can your guests also come up, the other panelists also come up in the meantime. Viwe is from Asanda Capital. She is the founder and CEO. Her business is a black female-led business, an investment firm focused on mobilizing capital to address Africa's infrastructure investment gap while advancing sustainable and inclusive growth across, not South Africa, across the continent. Please can you come up, take your seats. Really looking forward to this conversation. I'm missing one more person. Come up. Okay, please get the mic while we... Okay, one more person missing.
I haven't seen my other counterpart since arriving this morning, so I'm not
you're going to have
entirely
a one-on-one. How fantastic.
It's going to be beautiful.
So please, so now 15 minutes. I can actually claw back my 5 minutes. You don't have two people. So there we go,
We
15
can take
minutes.
this outside.
Viewer, all the best. You're going to have a fantastic conversation. Your 20 minutes starts now. Thank you.
Thank you. Molweni. My name is Viwe Tini. I am with the speaker's firm. I love how gently I've been let into this conversation today. I had thought, do I have both my speakers now? Look at God. I had the great pleasure of meeting Dr. Dudu last week. We were in a deal room together, and she very firmly announced that she's very recently doctored, and so we must not make the mistake of calling her Dudu. So please allow me, all protocol observed, ma'am. Right. I am the founder and CEO of Sande Capital, not Asande, Sande Capital. And I wanted to drop a few gems because I'm under a lot of pressure. The ladies that were here before me and the gent did a little bit too much. The lady with the keychain that was saying that part of her business is a keychain. The people that were speaking here who are from the capital mandate part of financial services were speaking about innovations. One of purchases that I made a couple of years back, I think I had gone to Mozambique at the time, and I got myself a keychain. And what was wonderful and interesting and very different to this day about that keychain is that when I couldn't find my keys, I could whistle and find the keychain, something to think about. Then there's a lot of speakers who have come on stage and they've spoken about, is your business practical? Do you have a market? I'm coming, gentlemen, please allow me. Yeah. I'm being a lady, I'm peacocking. There's a lot of practical insights that I think that an audience such as yourselves might appreciate. If you look at, we talked about the business plan and the J-curve. What I would like to challenge you to do this evening when you go home is take South Africa and put it on a business life cycle map, because that will determine for you where the country is, and that will help you find where the opportunities are. There's a lot of information that was given here about infrastructure and how we're at a place as a country and as a continent where we ought to be focusing on that. I would also like to share with you a resource. There is a publication called The Czar. Very often it's people that come from outside of our country that see the opportunities in our country and take the opportunity to do something with them. This publication you can subscribe to. There is a free option. There is also an option where you can pay a subscription fee of 150 Rand and you get a little bit more information. And what that does is that it gives you where the actual infrastructure problems are within the country. Now you don't need to think about a business plan because that's doing half of the work for you. Sit down with ChatGPT, look at you, you got you a business. Right, gentlemen, how are we doing this morning? Oh, I love that. So I have the privilege of having a conversation with a commercial banker, gentleman from APSA, as well as, can I use the shortened version and call it a CETA? I think to open up our conversation and to give a little bit of perspective to the people that we're going to be speaking to, because as soon as you come off the stage, people are going to come to you. I'd like you to outline what it is that is the key differentiators between the two kinds of funders that you are. And I'd like to start with you, Barnabas.
Okay, thank you very much, and also the opportunity to come and talk to the economic drivers. So, as the CETAs, we've got about 21 sector education training authorities, and you will realize that when you start formalizing your business, 1% of your salary bill, you will pay it to SARS, and SARS ultimately will give it to us, right? So, and there are thresholds. If you are maybe 500,000 revenue driven or more, then 500 or less and less, you are not going to have a skills levy number. But above, you will have a skills levy number. Once you start now having a skills levy number, you've got access to opportunities within all the sector that you are affiliating to. In this case, I am from a wholesale and retail sector, and our solutions, we are doing grant funding and special projects funding within the wholesale and retail sector. So I just want, before I talk specific to the sector, the content of this conference is very much interesting because everyone here is like, if I use the analogy of the nature, we are carnivores. Everyone wants project funding. Everyone wants to expand the organization through the means of leveraging funding from existing institutions. However, one thing that we forget to focus on is on leveraging on opportunities to increase the human factor or the capital investment in terms of skills and development. Because you look for projects that are going to improve your bottom line, and then once you are done with that project, you don't even have the structure that supports you and that can sustain your business. It's a hit and run kind of approach. However, now what we are looking at from a CETA point of view, we are looking at a transformation that integrates both the industry and the educational system. And that's where we come in through the vocational structure. So we fund programs that contribute to the mainstream.
It sounds like you've got a bit of an employment and in particular youth employment solution there. I will come back to you on that.
Okay.
I want to give Lebaka an opportunity to respond.
Thanks, Viva. From a commercial banking perspective, basically a little bit further, in fact, on the far end of the growth continuum of a business or the risk continuum of a business. So when you come from the CETAs and they fund you from inception, and other DFIs would then allow you to grow your balance sheet. Once you have a stable balance sheet, then you move on to the commercial banks. At that stage, we typically would be looking at how do we finance you in terms of what you have with regards to balance sheet financing. There are instances where we actually try not to look at balance sheet financing. How do we become a little bit more innovative and see past the balance sheet? But at that point in time, we understand the potential that you have as an entrepreneur, right, to build up that business, to become a corporate business in the South African market. So we may, just one of the different solutions that we may look at is you may come in with a particular contract from a well-regarded client. So we then don't necessarily look at your balance sheet. We will then look at that particular client and how do we then mitigate the risk through that, that particular entity. So yeah, ultimately commercial banks, they allow the DFIs to carry quite a lot of the initial risks. And then when you're in your next phase of growth, we will then help to facilitate that growth.
I hear betting on a jockey, and I think it's been a persistent and consistent theme throughout. And I just wanted you, Barnabas, to just take a little bit of time, just giving us a little bit of information in the room around, you spoke to something that triggered for me a response to the youth unemployment crisis that we have as a country. And if you could just give an indication of how best one can align one's business so as to be attractive to funders such as yourself.
That's an interesting question. You know, if comparatively with other African countries, when you look at our unemployment stats, and I've actually challenged the statistician on this matter in one of our conferences. If you look at Kenya and other countries, they look at markets that we classified as informal traders. And they actually formalized those businesses, and they are part of employment contributions, right? So in our case, we are not counting people who are trading, and we call them informal traders, and they contribute towards the stats. But there is also another factor that affects that stats. We have realized that most of the people that contribute to the unemployment stats, they have left schooling at grade 11. Most of them. And that group, they see themselves, because they are inspired by local entrepreneurs who got resourced otherwise. I will use that term, I will borrow that term. Who got the resource otherwise, and they start to demand things like a 30% on a capital project. And hence, initially I said it's a hit and run kind of a mentality. But if you look at it, come to think of it, they do not have the anchor in terms of skills development. I'm not necessarily talking formal education. They have not gone through the pipeline of mastering the skill, right? So the issue of unemployment, we can hire everyone today, but can they do the work? That's the question that we need to ask ourselves. So hence, from a SETA point of view, we are saying we are focusing on vocational training. Vocational training, it is all those technical colleges, the TVETs, that are teaching people skill, hard skill, to say you're a plumber, this is how you need to do things, you're an electrician, you know, a skill that when you get a project, an infrastructure project, like building a bridge or building a school and so forth, instead of hiring people from the corner, you will partner with a vocational, a TVET college, and they will give these people an incubation kind of training. So by doing that, you as an entrepreneur, you are going to spend less on your labor cost, because SETA will be paying for half of that labor, if not 100% of that labor. And your project costing, you are going to leverage on our funding, and then you're going to have a good returns on your project. And by doing that, we are empowering the pipeline that is coming behind you Tomorrow, it's not you who's running a project. It will be those people who are from a TVET. Now, they've got a skill, they've got experience and exposure. They can participate in the mainstream.
Right. Libaka, I'm coming to you next. I do want to warn my MC that I do have the gift of the gab, and I keep looking at her side, and I can't see her. So I want to ask Libaka another question. Okay, 3 minutes, she says. Let's see how we do. You flirted a little bit with the ideal of how typically commercial banks will take up the conversation with the entrepreneurs after they've gone through the organizations such as your CETAs, your DFIs, etc. My question then to you becomes, how has the bank augmented its offering to be able to assist emerging entrepreneurs, noting where we are as a country and as a continent in as far as what our economic growth is and what unemployment and infrastructure issues we have? That's over and above the, shall I call it a script of what typically the commercial banks would respond and say?
Sure. That's a very difficult question, especially given that I'm more of a corporate banking person. But let me try and and respond to that. So, and I think I've touched on it a little bit earlier with regards to some of the way that we look at funding entrepreneurs, where we would look at the particular project, the offtakes, and whether we can pass on the risk to those bigger corporates, right? And that means that we will then place less reliance on the entrepreneur's balance sheet. But then there's also the fact that we partner with I guess the DFIs as well, where they provide us with some of the solutions that allow us to obviously mitigate risk. Tate Masukameng also then spoke around grant projects that they have. There are some of those particular products that the DFIs would have that they would then allow the bank to use to augment our funding. So typically in normal commercial transaction, there may be a requirement for an equity contribution. We would then augment that with some of that grant funding, right, to cover that equity requirement. And then with regards to those blue chip entities or those corporate entities, they also have enterprise and supply development programs. We use that particular funding as well to augment our funding. So they may allow us to manage that on their behalf and to fund entrepreneurs out there, SMEs out there, but we would then fund alongside the corporates as well. So those are just some of the ways that we try to close the gap between where our risk lies versus where a typical up-and-coming, SME may be within the risk curve.
So strategic partnerships throughout the value chain of financial services. My dear MC, do we have time for questions? Otherwise, let's welcome the good doctor back to the stage.
Thank you so much. Thank you. So thank you so much, Viwe. So as I listened to how the CETA money comes back into development and training, I want all of us to commit to being those businesses that can actually have a levy to pay to SARS so that we can continue to empower the CETAs. How's that? So we all now want to have businesses that employ, I think he said 500 and above. So are we those entrepreneurs that are going to have businesses that have large-scale employment opportunities? I saw, that's me. Okay, but it's only one, so nobody, when I see another lady, and great, okay, we've got a room full of people that are going to want to pay that SDL, no? The SDL levy, so there we go. So we are going to be pumping more money into the CETAs. That's what I want to share. Fantastic. Thank you so much, Viwe. You don't just have the gift of the gab. You have a beautiful way of packaging that gift. Where are you? packaging that gift. May it continue. May I see you in plenty of stages, because I think you did that so well. Thank you so much. Okay, so we have a timeline. I love targets because it keeps me on track, and I want to get everybody fed by at least 1:30. So I need to beg your indulgence for 2 more sessions. The one I'm going to have Utuli Makubani. She's going to be my facilitator for the afternoon. And then the next one, we're going to have a masterclass from Lerato Mangope. Both very key conversations. You would have seen the logic behind our thinking. Please come up, Tuli, and your team and your panelist, as you come up. You would have seen the logic in our madness. We talked about what DFIs are, the differences between the different types of capital and the funding instruments. This conversation is now going deep into the full debt stack, from DFI facilities to commercial loans. So now, if you really have to lean into your notepad, this is the session, because now we're going in deep. So I want to invite Tuli and your guests. I look forward to an in-depth. She wants you closer because she knows she needs, there we go. Okay, give him what he wants, okay? He needs to give us the right information. So this panel has 20 minutes to really dig deep, and I know it's not a lot of time, but we want those quick nuggets around the differences, or it says here, the full debt stack, from DFI facilities to commercial loans. Thank you so much.
Thank you. Good afternoon, everyone. I know it's us and one more session before lunch, so please just bear with us. So just as a start, if we can have hands up, who's ever applied for funding, any type of funding? Okay. Keep your hands up. And then if you have received funding, keep your hand up. If you haven't, you can lower your hand. Okay, so it just seems like it's a handful of people that have successfully applied for funding and received funding. Thanks, you can lower your hands. And the rest of you guys, what happened? Okay, so I think today we're going to try and help you to maneuver through this obstacle course we call applying for funding. And today you've heard of different types of funding, what funders are looking for, but we just want to give you some of the insights behind the mechanics in terms of when you walk through a funder's door, what actually happens and how you should actually be conducting yourself. And today I have an esteemed panel with me, and I think I'll introduce each one of them in just a short while. I'm not going to spend a long time just getting through the introduction. So when I ask the question, I will then be able to introduce the panel. So to start us off, we're going to start off with Yandiswa. Yandiswa is an investment analyst, investment associate. I'm demoting you. Apologies for that. She's an investment associate at the National Empowerment Fund. And before joining NEF, she's also worked with business partners. I'm sure some of you are familiar with business partners, and it is a private sector funder. And she's also worked at Sanlam Private Wealth and at Grant Thornton. So she'll be giving us some of the views around the DFI conversation. So to start us off, Yandisa, I'm sure you've worked with entrepreneurs both in the private sector and in the public sector space. So in your view, when entrepreneurs actually move from one funder to another, what are some of the things that you have seen that entrepreneurs don't actually think about that later on actually impact their reputation or their track record when it comes to applying for funding?
Good afternoon, everyone. Yeah, so with regards to, the ecosystem of, lenders, I think what entrepreneurs forget is that your behavior from one place to another matters, right? Because there is an ecosystem of funders, whether it is a DFI or a credit lender, or, the asset-based financiers, venture capitalists. There's behavior that they monitor from one place to another. So one person may, apply maybe at the NEF, at an early stage of their business. And then at a later stage, they successfully apply, and then they move on at the next stage to maybe an ABSA or whatever commercial bank. But their payment history and whatever behavior that they had, they would not think about that would impact their future credit record, right? And not only from a credit record perspective, but behavior of how they treat their debt, right? And how they interact with the funder, because it is an ecosystem where we all do work together in one way or another. Yeah.
Thank you. And then coming to our next panelist, we have Mr. Thulani Guliwe, who is from the Gauteng Enterprise Propeller. He's a very well-learned individual. He's a senior researcher, and he's involved in strategy development for GEP and for Gauteng Economic Development. He's currently pursuing his PhD on industrial innovation, and his background is across strategy, leadership, and executive coaching. So coming to you, Mr. Guliwe, I'd like you to just expand on that. What you have seen as some of the common pitfalls or mistakes that SMMEs make when they're applying for funding or moving from a DFI to a commercial loan or beyond that.
Okay. Good afternoon, everyone. I think the common mistakes that they make is that they struggle with sometimes the basic documents in terms of compliance. They don't submit the whole package. Sometimes they don't follow the procedures. I think that's one. The second mistake that they make is that most of them, they don't have, if they apply for funding at most, they don't have a credit a record. They don't keep records. When we're supposed to fund them, they become risky businesses to lend. I think the third one is that at most they tend to follow what is common, what is successful in there, not what they think this should be my space. So as a result, the other issue is the issue of they don't do market validation. They don't conduct a proper research. That's why when we would have funded it, they struggle, to pay our funds because the market is not there. At some point, you find them being located at an awkward environment other than where their client base are. So those are the issues that post-investment ends up dealing with them in terms of they have to restructure the deals at the end because of the issues that they make at their initial stages of application. Thanks.
Okay. Thank you for that. Then moving on to Mohome here on my right. You can look deeply in my eyes. You're welcome. So he is the founder and CEO of Kulu Capital. Started his career in investment banking. He's also been a deal maker, is experienced in fund management, and started the current business in 2020. Interesting time to start. They focus mainly on mezzanine debt. And I guess maybe it's a product that a lot of entrepreneurs may not be familiar with as we sit here in this room. Perhaps to just start us off, maybe highlight, the gap that private credit actually plays in the debt ecosystem. I think people are familiar with DFIs, they're familiar with banks and commercial loans. So you come in some way sandwiched in between. Perhaps just enlighten our audience in terms of mezzanine debt and the type of work that you play.
Okay, thank you very much. Good afternoon, everyone. Okay, so I'll first start by just introducing Colo Capital and also mezzanine debt, as an asset class. And then hopefully in my introduction, then it starts giving you guys an understanding of what mezzanine debt is. Okay, so as Colo Capital, we are a 1.4 billion rand mezzanine debt fund. We invest in medium-sized businesses. Our ticket sizes are 70 million rands to 275 million rands. We invest in all sectors, including real estate, excluding primary mining and excluding primary agriculture. So now, a lot of private equity funds as well, they have the same exclusions. But then having said that, we love mining services, we love mining products, we love mineral processing, we love mining logistics, mining transportation, materials handling. So everything else around mining is fine, it's just the actual mining itself that we can't do. And then on the agri side, we love agri processing. Or for example, if there's a business that's vertically integrated, across the food value chain. So let's say if the business, they do farming, they process, they package, they distribute, then that's also fine. We invest in 5 markets. So South Africa, then CMA plus Botswana. So CMA is Common Monetary Area. So those are countries that basically have the same currency as South Africa. So their currencies are actually pegged to the rand. So South Africa, then Namibia, Swaziland, Lesotho, and Botswana. We provide growth capital. We provide acquisition funding. So for example, if a business wants to acquire another business, we can provide the funding for that. Or if you want to acquire a business, we can provide the funding for that. We fund management buyouts. For example, if the management team wants to buy the business that they work for from the original founders, we're able to provide the management team with the funding, to acquire that business. We also support shareholder liquidity events. So meaning that we support shareholders to take money out of the business. So for example, we can put funding into the business and the business can then declare a dividend. The same amount of funding, declare a dividend to shareholders. We can fund share buybacks, either a specific share buyback or a general share buyback, for example. So if one shareholder needs to exit the business, we can put funding into the business and that funding can be used to buy back the shares from that specific shareholder. Or we can do a general share buyback whereby all shareholders can take money out, pro rata to their shareholding in the business. And we can also refinance shareholder loans. And okay, so in terms of our mandate, so the businesses or projects that we invest in need to be generating minimum 25 million EBITDA. So profit before interest, tax, and depreciation at the time of investment. What else?
Let me come in there while you think. So, private credit is somewhere in the gap between what banks won't touch and what DFIs perhaps would move slowly to fill in. So give us an example of a deal that you funded that will illustrate the gap that you play as a mezzanine funder.
Okay, cool. So,
not to look briefly.
yeah, that's fine. Okay, so if you look at mezzanine debt, I think to understand what we do, right? So this is our value proposition. So what we say is, first of all, we don't compete with the banks. The banks are always your cheapest cost of capital and your cheapest form of funding. So where we come in is, if there's an equity funding gap, the business needs to raise equity for whatever reason. So meaning that the business, for example, has approached the banks have provided maybe some of the funding, and there's still a gap, right? Meaning that the banks have reached their limits. Okay, let me give you an example. The business needs 100 million. The banks only have appetite to provide the business with 60 million. So now there's a 40 million funding gap, right? So where do you raise that 40 million? Okay, first of all, if you have it, you can put your own 40 million into the business. If you don't have it, typically you would then have to approach other equity investors to provide your business with that funding. Now, the problem with that is when other equity investors come into your business, they also gonna want a shareholding in your business and dilute the shareholding that you have in your business. For example, you might have to give away 30% or 40% of your business. And that 30%, 40%, once you give it away, it's gone and it's gone forever. It's no longer yours. And this is where we come in. So we say, okay, that 40 million, instead of raising equity funding, come to us, we will provide that amount as a loan instrument. Okay. So we provide this amount as a loan instrument, so it's a subordinated loan. Very patient capital. You know, we can provide, let's say, the loan for 6 years. Bullet loan, meaning that the business doesn't have to repay any capital on the loan during the tenure of the loan. The business only has to service the interest on the loan. And we're very flexible because, especially let's say in the first year or two when the business is still growing, it's still ramping up, we can even roll up interest on the loan. So meaning that potentially in the first year or two, you don't have to pay us a single cent. You can just focus on growing your business. Now, after 6 years, the business can either repay the loan or refinance the loan with cheaper bank debt. Then you pay us, but you still own 100% of your business. So that's essentially what mezzanine debt is. And hopefully, as I was explaining, that you start to see where bank debt fits in, where mezzanine debt fits in, and where private equity funding fits in.
All right, thank you for that. So moving along, coming to you, Yandiswa, I think entrepreneurs usually have this view that to get debt, you need to have immovable property as a security. And I believe that the NEF has a different view and perspective when it comes to collateral. Please talk us through that.
All right. So ordinarily, your banks, your commercial banks would be looking for physical property as security, right? That would be their best bet as collateral. So as the NEF and most DFIs, we are more lenient as our mandate is more developmental focused, more than it is on the returns. Obviously, for sustainability purposes, returns are important, but the developmental impact is more important than just getting returns, because we've been mandated by the DTIC and the government to transform the economy and to bring development into the economy and create jobs. So in terms of collateral, what we would look at, there's many very different aspects that we'd look at collateral at. So whether it is movable assets, the assets that you have in your business, whether it's machinery, furniture and fittings, that is collateral that we could take. We could look at de-risking the loan by maybe taking a cession of debtors, or if you've got any contracts that are tied to this funding need that you have, we could also, if they are willing, those your suppliers or your customers are willing to sign, if they're willing to sign as a guarantor for that loan, we could also look at that as collateral as well. So there are many various options that we can take as collateral. It's not just necessarily an immovable property that we take as collateral.
All right, thank you. And I guess now you know that, there's different types of collateral that the funders would look for. Mr. Guluwe, coming to you, I mean, in terms of the research that you've done in Gauteng and I guess in other spheres, what have you seen as one of the pitfalls that SMMEs fall into when they are applying for funding? And, people usually start the application process, everything looks positive. and then suddenly they get that decline letter just when you thought everything is moving along properly. Maybe take us through some of, the examples of what, failures that you've seen that people fall into when it comes to the application process, and especially at due diligence stage or later.
Yeah, I spoke about the issues of misinformation. I think there is also this issue which is common, the failure to strike a balance between your personal account and your business account. They tend to mix that. When you do the assessment, it's the opposite. They become risky businesses. Then we are unable to do that, to support them. Then the other issue is that the issue of judgments. There are debts that you take them for granted, that end up impacting in future, like your Edgar's accounts and what, and also using your business account to buy alcohol and others. We are able to track those things. They impact, at a later stage when you need it the most. So I think those are the issues. But the other issue is the issue of the failure to read the financials and make the right financial projections going forward. And then from time to time, even when we train them in terms of using our systems, they tend to resort to the manual ways of managing a business. So those are the challenges that tend to impact on their business in a long run. Thanks.
If I may add, Tuli, we also look at misalignment in your story, right? Because as a funder, we look at your pitch deck, your financial records, and your actual business and your bank statement as a story that it's telling. And that story needs to be aligned. One can't come and present a business plan or, financial records that say the company's making A, and then you look at the bank statements, and then the bank statements are telling a completely different story. So there's misalignment that we sometimes see in people's stories from what they're presented at a business plan, then when we actually do due diligence and we are looking at the business at a deeper stage.
Thank you. Okay. As the last question, NEF, you price risk differently from banks and other commercial funders. Maybe just illustrate to us how you would actually cost that and what the cost difference is, and also what other non-financial covenants and obligations would you put in place that wouldn't necessarily be reflected in the interest rate?
So our pricing model is different from the banks because it takes into account the socio-economic benefits that the business is going to bring, right? So we would look at what is it that the business is doing that is necessary in the economy. So are we funding a woman? That would be priced different from funding a man. Are we funding youth? Are we funding disabled persons? Are we funding entities that are in specific areas, rural or township areas? That would also look different when you're funding those. How many jobs is this business going to create in the economy? That would be also another key thing that we use to price the transaction. Whereas, commercial banks would be looking at a prime plus sort of pricing. We would take all of that into consideration. I think also
So you've actually touched on it already in terms of what else you'd consider in pricing your deal, yeah.
So non-financial aspects that we would look at is how much jobs this business is creating and how much impact it's making in the economy or the community that it's trading in. That would be one thing that could be tied to, the covenants that would be in the loan. Also, in an industry that is not transformed, the transformation that this transaction could bring in a particular industry, that would be something that also we could look at as a covenant that is in our loan agreements.
All right, thank you very much. There's so much more we wanted to share with you, but as you can see, time was not on our side. Our panelists are going to be around if you want to engage them further. And thank you very much for the opportunity to share some of our insights with you. And all the best in your funding application journey. And hopefully next time, I'm up here and I want to see the hands of those who've actually successfully received funding. It will be half the room.
Absolutely. Thank you, Sis Tuli. So I was one of those recipients, Yandisa, that got rejected by the NEF, but they were so gentle. I'm not biasing them, not telling on them, but they were so gentle in their response because they gave us really great insights into the stuff that we had missed. So the one comment which I chuckle at, it's now my new phrase, is they said, potential is not proof. So as much as we think our businesses have potential, they wanted proof around what it was that we were going to, you want the proof. And it was very detailed. I think I got a page and a half. So that also was an indication that the DFIs genuinely are developmental in their approach because the person took the time to actually read my proposal. I didn't feel like they just kind of fobbed us off. It was, they gave us a page and a half. So as much as the rejection was like a bit sore, but it was great insight. So now we're able to do a lot more, like we're able to put our things together quite nicely. You mentioned the issue of Pick and Pay swiping on your business accounts. Can we please, entrepreneurs, separate our businesses from our personal business? That we're not seeing things that look clearly like personal expenses, because that does disadvantage us when we go for funding. And with that, thank you so, so much for your time and for those insights. I didn't take, and as you leave the stage, I want to take the opportunity to tell you who Mrs. Tuli is. She is the Director of Mint Fresh Advisory Services. She's an entrepreneur, a business strategist, a podcaster and enterprise development specialist with more than 25 years of experience. So if you thought, as she's speaking, no man, I know this voice, which is, as I was sitting there, I'm thinking, no man, this voice is a voice that I know. Mrs. Tuli is the former host of Kaya Biz, My Money and Me on Kaya FM, and is currently the host of the Success Rate podcast, where she shares inspiring stories of entrepreneurship, leadership, and business success. So that's where this familiar voice comes from, Mrs. Tuli. She is rated as one of South Africa's top businesswomen and continues to champion entrepreneurship and economic empowerment across the continent. Thank you so much. So, I know I'm not in church, but I want to say we serve a living God, because Oslebo has decided she's perfectly okay with us taking her session, Oslerato rather. She's happy for us to take her session after lunch. So we are going to break for lunch, and we are going to give ourselves exactly 45 minutes. So I would appreciate it if all of us could be back here at 2 o'clock. And what I'd like you to do is eat quickly and then go to the clinic. Because in the clinic, we do have SARS is in the house. We've got the NEF, whom I'm going to go and now consult and see if my proposal maybe might see the light of day, hint, hint, nudge, nudge. We do have SETFA as well, and we've got Wenzile Capital. You cannot leave this room without going to see Wenzile Capital. They will help you understand how business ready you are. The lunch is going to be served outside close to the pool. Also take the opportunity to take a walk around the room. We've got amazing entrepreneurs that are here displaying their products courtesy of APSA. APSA is also still looking for you at their table to please come and do the things you need to do. There's lots of forms that have to be filled out, so please do take the time and do not forget to go to the APSA stand. I've got Mr. Masiza.
Thank you so much.
Sure.
I just want to, we have I'll ask Kashifa just to explain, but the line should be right. The clinics are that side. But for you to have an access to the guys, you have to do, the compliance form. But let me ask my colleague, Kashifa, just to explain.
Hey everyone. Thank you to leadership. So the EPSA entrepreneurs, you know me and I know you. We've spoken. You received a sponsor ticket from EPSA. I'd like you to kindly go to my colleague Tabiso. I'll also be there so that we can complete your required compliance forms. You know yourselves. All right. So EPSA sponsored tickets, please come to complete the compliance forms. We're right outside. And that's it from me, sir.
And then for clinics, if you have SARS issues, you're looking for funding, you have done application with SAFTA, CIPC specialist, you go to our offices. If you move and then you use that entrance, you turn right, you go to the EmpowaEntreprenuers reception there. You must book your spot. If you want to talk to SARS, you want to talk to SIFDA, you want to get some mentorship, you go that side, okay? For now, we can go to the APSA. For the entrepreneurs, you know what is needed for you. Please make sure that you use that space while they're set up for catering in 10 minutes. When are we coming back, the big doctor? Guys, 2 o'clock, let's not fetch you. You are looking for funding before it. 2 o'clock, so that we can wrap up in a cut. We'll see you at 2. Thank you.
And then wait, so it's literally...
1, 2. I know Dr. Dutu has stressed this, but I will stress it again. For those who have not completed their ABSA forms, we really, really kindly ask you to approach the desk outside there. If you have been here during the week, this week, last week, or the week before, for all your ABSA forms, please, all ESD forms that need to be finalized, please go to the desk outside. And for those who are starting to complete them, please go to reception, to our clinics to complete those there. For those who still need to complete forms, who are part of the APSA SMS and emailed team, please go to the clinics. The clinics are just around the building, the office building. You will see a signage clinics, you will see ABSA, you will see there is SARS, and there is Wenzile Consultants. Please go there, and we are able to be assisted. Thank you so much.